This video is for thoughtful discussion. It's not meant for financial advice. I'm not qualified to give financial advice. It's information that may interest you to do further research. If any of this information concerns you, please talk to your financial advisor about it. Note, Hedera is a sponsor of the Lighthouse report. Therefore, if I mention anything regarding Hedera in this report, or any report, note that I have a bias.
As you can see, this is Silvergate Capital. Silvergate Capital has completely done a hole around the world. So it's right back to where it was at support. This is very unusual for banks. Banks shouldn't behave so volatile, and this is because of their exposure into the crypto world. Now, what's interesting is they took on $1 billion loss in the fourth quarter of 2022. So this all transpired from when FTX pulled out more than $8 billion in deposits, which essentially caused a bank run. Now, a bank run is when all the customers take their money out at once, and this is really bad for banks. So when something like that happens, they make these levered loans, and they spread out the loans all over the place, and then customers deposits back those loans. And when they pull that money out, they don't have the assets to back up the loans that are on their books. So that's a recipe for failures. The official statement from Silvergate stated that it's actually minimal exposure, but when you're writing down that you had $1 billion losses, something is up. So this is their recent balance sheet. So you can see they've been in an upwards trend ever since they got into crypto, but after FTX collapsed, now they're reporting losses. So this is gaining momentum, and now it's on the other side of this. So what ended up happening is they took out $9.9 billion from federal home loan banks. Now these banks are set up by the government. This happened after the Great Depression. They set these banks up to offer really low interest loans, and these banks work with the government to offer those loans, and it's a way to try to bring economic activity, and they try to give loans to banks to spur economic activity and get people into homes, and the government backs these loans. So what ended up happening is a lot of this money made its way to Silvergate and Signature Bank, which were lending it out into the crypto world. So this is just the facts. You can guess what happens from here. Your guess is as good as mine. I don't know exactly what's going to happen, but these are signs and symptoms, so we will find out. But if Signature and Silvergate end up defaulting on their loans to these banks, the taxpayer is going to have to split the bill with this. Now, what ends up happening is all these banks are interconnected. They're all levered balance sheets from each bank. They have assets and liabilities, and they all share assets and liabilities. It's kind of this incestuous relationship. And when one bank fails, it starts a chain reaction. And that's what we've seen in other financial crises. You see one bank fail, and then the next bank that owed them money or borrowed money from them fails because they can't pay back the money that they borrowed. And it just keeps going like a domino effect. So this has the potential to start a banking collapse. And that's what Elizabeth Warren has worried about and has cautioned about. Now, if that were to happen, the good news is that they would have to put crypto regulations at the top of their list, at the top of their agenda to solve, because they couldn't have another issue like this in the future. So we would get our regulations very quickly if there was some type of bank collapse.
This is why I've been warning of the dangers of allowing crypto to become intertwined with the banking system, said Senator Elizabeth Warren, D. Mass. Under no circumstance should taxpayers be left holding the bag for collapses in the crypto industry, a market brimming with fraud, money laundering and illicit finance. The banks began hemorrhaging deposits last year when crypto prices collapsed and FTX, one of the industry's largest exchanges, filed for bankruptcy. The two were among a small subset of banks that vacuumed up deposits from crypto companies when the industry was booming and many other banks shunned their business. Deposits declined at Signature in 2022 for the first time in its two-decade history, dropping below $89 billion from nearly $103 billion at the start of the year.
Likely would not accept a $1 trillion platinum coin if the Biden administration tried to mint one to avoid hitting the debt limit. Some Biden officials had previously said that the Treasury could use a law that would authorize platinum coins in the event of a potential default. This all comes as Congress gears up to battle over raising the debt limit. Republicans are currently pushing for Democrats to agree to spending cuts in exchange for authorizing more debt. The $1 trillion coin has been something that had been at the fringes of financial circle discussions and then had become more into the mainstream in the past couple of years.
The U.S. government is running a Ponzi scheme. They issue treasuries to finance their previous debt. The public purchases bonds from the government with a small rate of return. They're borrowing from the public to pay back previous debt. That's what Charles Ponzi did. He would take in new investors' money to pay back the old investors. And that's what the U.S. is doing. Politicians will say things like it's critical that the U.S. pays their bills, but there's $31 trillion in debt that has gone unpaid. We're spending beyond our means. Tax revenue is not enough for how much we spend. Now some key people in Washington are proposing minting a $1 trillion coin made out of platinum. Paying the Fed with a 1-ounce coin of platinum that they decided was worth $1 trillion is just creative accounting. Normally, I would think this is just nonsense, but some key people in Washington are backing the idea. The debt ceiling needs to be raised, and our politicians are polarized. The Republicans are guilty of passing laws to increase our debt, but to make a statement, they're going to politicize the debt ceiling. If they do it, it could cause some turmoil in the bond market. Volatility in the bond market could cause some very big problems. This is a chart of the bond market. So this is an index of treasuries, right? So what's happening is if they fight over the debt ceiling, it's very possible that people sell their treasuries because they don't want to take on the risk that the government might not pay them in time. So especially short-term treasuries, this could cause a dump. And then what ends up happening is rates increase while this sells off. So this could be a catalyst as well. Now, we've seen this happen in England, and this is where the Bank of England pivoted because their bond market sold off, and this was right after a UK spending bill. So the debt ceiling could be our crisis like that. And then we move straight down because people are unsure that the government's going to actually pay them for the treasuries that they hold. So that could be a catalyst. Just taking a while. I'm not saying that the debt ceiling won't get passed, but stalling on it, dragging their feet to actually pass it will cause the markets to be insecure. It will cause them to panic. And then once it happens, it's too late. Credit to Lead Lag Report, and Lead Lag Report brought this to my attention. Now this chart represents each time the Fed pivoted, as well as the S&P 500 drawdown. The S&P is the largest index in the stock market. You know, they're a very large portion of wealth. So when they sell off, most markets move with the S&P 500. Now, you can see each one of these triangles is where the Fed pivoted. So they were at high interest rates, and then they lowered them. And once they lowered them, that's when the sell-off started. So this sounds counterintuitive, right? Because we went from this environment of cheap, easy money to less money, and then we go back to cheap, easy money. You think that the markets would rally, but no, the data is showing something completely different. And now this is a sign for me. I originally had my strategy to set up around the Fed pivot. Well, this data suggests maybe I should wait a little while before I actually start buying again. So this was really important to me. You can see each one of these triangles represents the sell-off. Now, the only two times that something weird happened was in 2000. You could see that they went sideways, so they left it unchanged, which the market is hinting at Powell might do, where it keeps it sideways, and then eventually when they lowered it, that's when the chaos came. So it's very possible that Powell does the same thing where he keeps it neutral, and pauses, and then As soon as he starts lowering, that's where we see the problems. Now, you can argue there's probably more evidence, and the Fed gets lag data, so they don't know what's happening in real time. They're working off of old information, and it's very possible that this is just something natural within the markets that start selling everything off, and then the Fed's reacting to that. But either way, you could see from the data that that's been the pattern, and it's there's no other time that that this has worked without it. The 1970s, they blinked and the sell-off stopped, and then it sold off again after they lowered the interest rates.
I hope you enjoyed this content. Let me know what you think in the comments below. Be sure to like and subscribe to the Lighthouse Report and check out the other content creators.